Fantastic. Okay, so welcome to everyone. This is our second series, and we are focusing on making sense of the numbers. So, on our first series, we talked about valuation, preparing yourself as a buyer. Now we're actually turning our focus on your own agency, the health of your agency. And as we approach the year end, maybe even thinking about looking at your numbers in a different way, creating a budget, etc. So in this one, we're going to dive pretty deep into the P&L and the profit and loss statement and what some of these numbers mean, what you can do with these numbers, what we do with the numbers when we value an agency or we work as fractional CFOs. So we're going to give you some little tips and tricks of things to make sense of these numbers so they don't just look like digits on a page. They actually can tell a story to you and actually allow you to make some strong financial business decisions inside your own agency. So we're going to kick off and get started. I would encourage you, if you've got questions about certain things that we're talking about, please put it in the chat. There's I think we had somewhere around 30 some people register, but there's not that many people. If you want to unmute and ask a question, please feel free. I would rather answer your questions and make this as meaningful for you as possible. So, all right, let's jump in and talk about getting to know our numbers. So, as you know, many people who are business owners maybe don't have a finance degree, maybe don't have an accounting degree, maybe they don't even have a business degree at all. So, looking at numbers can actually be some of the most anxious things that they have to do, and the area that maybe they're least comfortable in running their business. I find this to be true with lots of agency owners. They say, man, I love talking to people. I love leading people. I love selling insurance. I love coverage. But the least favorite part of my job is having to make sense of some of these numbers. So I'm going to go through and tell you what context I see in the numbers, and you might be able to see as well. So this is what a profit and loss statement looks like. The first might be exactly what your numbers look like. In this example, we're looking at an agency that has 1.25 million in revenue, in total commission and fee revenue, with total revenue of 1,402,000 in revenue. So we just use this as an example to show how you might think about your numbers differently. In the annual amount, those dollar amounts mean almost nothing, especially if you don't have them in the categories that we've classified them in. So first and foremost, we are very fortunate in our industry to have very strong benchmarks. We've got a lot of data out there that you can use as a guidepost to say, how is my agency doing compared to other agencies of similar size? So first and foremost, you have to put your profit and loss statement into the same categories that these benchmarks use. So in this example, we've taken this agency's P&L and we've classified it into these standard categories. So we've put commission and fee income, other income to get to total revenue. We've then classified all of their people expenses into payroll, and then added payroll taxes, retirement, insurance to get to the total benefits, to get to a total compensation number. The next category is their selling expenses, which includes marketing, travel and entertainment, auto expense. I call marketing, advertising, and promotions. But again, classify all those selling expenses into one category. And then all your operating expenses go into one category as well, broken into different classes inside that category. So you can see how much am I spending on the place where I do business or my occupancy. That would include your rent, your utilities, all the repairs to the place where you operate, any of the maintenance that's done on that building, maybe an alarm code, like all of the things that go into maintaining the place where you do business. All of your IT is all your technology, your supplies and printing, postage, etc. So once you get them into this category, you can calculate what percentage of my revenue am I spending on each of these categories. And that is where you can start making sense of the numbers to say, other agencies of this size, there's a benchmark amount that's given that says this is what the average agency is spending on payroll, on total compensation, on selling expenses, or any category listed here in this benchmark category. And then you can say, okay, based on my agency, how am I doing to get to a benchmark variance that is created by looking at your amount, your percentage of revenue, the benchmark's percentage of revenue, and the variance. But without being able to classify into these categories, the benchmarks mean absolutely nothing to you. So, number one, this is the first step for you to figure out and make sense of your numbers, is to classify your P&L the same way that the benchmarks are. So now they're a useful guide to you. So when you compare to the benchmarks, I'm gonna hone in on some of the benchmarks that are most meaningful to agents when they do this. So as you know, your people is your largest expense. It's also your biggest asset. And many times people want to know, how much should I be spending based on the size of my agency? How much should I be spending in total compensation to my people? And it's also an area that if you're not in line with the benchmarks, really honing in on what your compensation strategy is for each of the roles inside your agency could be a very big area of concern, and also area that you want to dig into and get right. Because if the largest expense inside your area is off, it might be very difficult for you to make investments in other areas of your business in order to drive growth, drive profitability, and position yourself to have the infrastructure to be able to acquire other agencies, etc. So in this situation, this is just an example agency that we used. Basically, their payroll is $760,000, or 54.2% of their total revenue. So I took their total revenue amount, I took their total payroll and divided it by that 1.4 million in total revenue to get to this percentage. But as you can see, the benchmark is 47.6. So this agency is actually over the benchmark by 6.6%. I then did that for each of these categories, and you can see already out of the gate for this agency, they're going to be over the benchmark in compensation by 4.8%, which means it's going to be difficult for them to make the same types of investments that other agencies are, or it's going to be difficult for them to have the same profitability of other agencies their size. And why is this important? Well, we all like to think that the same size agency will command the same type of value if you go to sell your agency. And here's why that's a bad assumption. Another agency that's also 1.4 million in revenue, that has a comp structure that's in line with the industry or even under the benchmark, actually will have a higher profitability overall, therefore will have more operating profit that is multiplied times the same or similar multiple to get to a higher value for that agency. So agencies are valued based on their operating profit and the risk inside their agencies. So if your operating profit is less or has greater pressure than other agencies, you will not command the same type of value as other agencies. That's number one. Number two, you might have difficulty selling your agency if your comp structure is different than the industry average, because a buyer wouldn't be able to pay the same rate as you would be able to. So by doing this and knowing what the benchmark is, knowing how you compare to the benchmark could make you dig in and actually spend some time correcting um, your compensation structure or getting it as close to the industry benchmark as you possibly can. This is far more impactful than just saying, is 760,000 a good number, a bad number? Should I be thinking about it differently? You might think of, how many people you have employed to do this body of work, and there could be a capacity conversation that would drive you to. But again, knowing that benchmark and how you compare to the benchmark allows you to start making sense of these numbers rather than just seeing a whole bunch of numbers on a page. The last thing I'll say is, if your number around your people is spread out all over the place, you're going to have a really hard time being able to get to which numbers do I pull together in order to make it compare. So getting your P&L organized in the same way as the benchmark's first step, and then it allows you to start making some great decisions about your agency. Okay, so people is without question is one of the areas that you should pay the most attention to, but there are benchmarks on this page that work together. And so oftentimes I'm a guest on some podcasts, and they'll say, well, give me what the average agency should spend in their people or in marketing or in um, you know, anything, technology. They'll ask me, what is the range that an agency should spend? And my answer is always with a big asterisk, because it really depends on how all these benchmarks work together, not one benchmark. Every agency should be right at the exact benchmark for other agencies their size. The beauty is they're guides, but they are not an absolute. So for instance, an agency that's making a lot of investments in technology and spending more than the average agency, like this agency, should have more efficiency created by the technology that they've invested in, and therefore potentially pay less in their payroll because they can do more with less people because their technology is helping them. That is a common assumption that agencies should make. But in this case, this agency is actually paying more for their people, and payroll. They're actually paying more for their IT. They're allocating 3.2% of their total revenue towards their IT expense when the average agency is 2.8. The other things to consider is, are they outsourcing some of their work away from their current, like their W-2 staff? And that would also be something to think about if you have higher than average professional fees or outsourced services. You might have less expense in your W-2 people. For instance, if you outsource your accounting, you wouldn't pay a bookkeeper internally potentially. Or if you outsource your IT, you wouldn't have someone on your staff being paid to maintain all of your equipment, etc. So these numbers work together. And for some agencies, it could be that their staff number, if you don't know how they work together, you might actually be over investing in some areas, therefore might want to rethink your strategy and say, hang on a minute, am I expecting my people to do the right capacity based on the technology I've invested in, the infrastructure that I've invested in, the outsourcing and capacity that I've created utilizing VAs or outsourced services, and really look at all the things that go into this. So you can see outsourced services is actually right at the benchmark, and professional fees are actually above the benchmark. So for this agency, we would ask ourselves, are we truly getting the capacity that we need from our technology investment, from our outsourcer, or from our professional fees, and it's not showing up as a reduction in our payroll? We probably either have a compensation challenge that we need to pay attention to, or this agency could just be staffed for growth, and that's totally fine. But it allows you to start having some questions and some real data behind the things that you would ask about your agency, if that makes sense to everyone. Here's the second example. And so for this agency, they're actually operating at a 20% EBITDA when the benchmark's 18.5. So while their payroll and their expenses would indicate that maybe they're over investing and not getting the results that they want. This agency in fact is actually growing faster than the average agency. So that is a way to explain the investments that are here. But if I just use those benchmarks, I might start, thinking that we have something wrong, but they're actually results. Even though they are over the benchmarks in some areas, their overall results and profitability are positive. So therefore, I happen to know this example really well since it's my example. They're growing faster than the average agency. But hopefully, I've outlined some different things that you can ask yourself when you're thinking about your numbers and what it looks like. So, the second thing I would say is obviously technology makes a big difference on the capacity of your agency. So does advertising, and that advertising investment that you make could actually impact your overall growth for an agency. So these are some common areas when agencies come to us and ask us to either benchmark them, value the agency, or work as their fractional CFO. We go through a process where we organize their financials, we look at the benchmarks, we show them the variances, we show them the variances in their performance in both growth, overall profitability, and we start to build a story of what their numbers are telling us. So for this agency, again, they're growing faster than the average agency. They're investing about what the industry benchmark is in advertising, but their results in growth are far greater than the average agency. For some, at their growth rate, you would expect them to actually have much higher marketing dollars than the average agency, but they're able to do it through referral. They're able to do it in non-actual dollars that are hitting their P&L, but in the relationships and in their process inside their agency. So again, some of the ways to just look at how these benchmarks work together and ask yourself some questions. In no way do we ever just automatically recommend to someone that you move yourself to the benchmarks unless you're not getting the bang for your buck out of the investments that you're making, or unless you're not getting the performance overall for the agency. Then we have to go back to the drawing board and look and see where could we make adjustments, where are there things that maybe are skewing your investments and not getting you the results that you're looking for. Okay. So I talked about a growth rate, and I want to make sure everybody knows how to calculate their overall growth rate inside their agency. This is also an area that if you're looking to compare yourself from an allocation of resources, like we just said, you also need to know, how's my growth rate compared to other agencies your size? How is my profitability compared to other agencies my size? So let's talk about growth rate overall and how you would get to the number that you would use for that organic growth rate. Most people want to go down to the bottom and use the total net revenue and compare it to the previous years in order to say, how much is my agency growing overall? But not all revenue is created equal. So as you can see, this agency writes some bonds. They also write some life, which do not renew at the same rate as other, they don't have the same behavior as direct bill, agency bill, fee income that all has a renewal rate that's pretty predictable. So number one, know what revenue streams are inside your P&L and make sure that you are comparing only those things that would continue to grow with you and won't just fall off because they have a life. So obviously bonds, depending on the type of bond, only has so long and it actually doesn't renew. And same with life. It's not gonna behave the same way as P&C. In addition, your contingency income, your interest income, whether or not you actually sold a car or sold a book of business, etc., could also skew the number. So if you just took your total net revenue and compared it to prior years, you might catch some peaks and valleys that were created by your contingency income, by peaks and valleys in your interest income, or other things that really don't behave the same way as the rest of the revenue in your the bulk of the revenue in your agency. So it could actually skew the numbers. So I'm going to show you if I calculate organic growth for this agency using this formula where I use their current period revenue that we've isolated, less the previous period's revenue divided by the previous period's revenue. That's what gets me my organic growth rate. I need to make sure that I eliminate any revenue that shows up in this period as an acquired book of business because that'll skew the number. That actually isn't organic growth, that's growth by acquisition. And I want to make sure I eliminate from both of them the revenue that doesn't renew, so it's not skewing the number, or that doesn't have the same behavior, that contingency income, etc. So with the numbers that we provided, let's take a look at what that calculation looks like. So I took the numbers that all the revenue that would renew. I looked at 2024 and then compared it to 2023, 2022, etc. I use the direct bill commission, the agency bill commission, the fee income, the benefits income as the revenue that is my previous period number as well as my current period number. And I calculated the growth rate. So in 2023, the organic growth rate was 13.6%. From 23 to 24, my growth rate was 11.8% for an average of 12.7. Hopefully everybody's following me. I did not take into account the bond income or the life income, and I didn't take into account the other income, which includes contingency, etc. If I would have just went to my total revenue line, my overall growth rate would be inaccurate and it would have been at 19.7 for 2023. It would have been at 12.6 for 2024, 23 to 2024, for an average of 16.2. Oftentimes, if agencies owners don't understand the numbers on their P&L, they could actually falsely think they're doing better or potentially falsely think they're doing worse than the average when those numbers don't make sense. The worst thing I've ever seen is an agency sent me their financials and in their revenue included the income, they included their trust account information. So they actually included premium dollars in their revenue and then subtracted what they sent to their carriers as cost of goods sold. So unfortunately, this agency had been operating that way for many years. They wanted to sell and they thought in a multiple of revenue like many agencies think. So in their minds, they went to their revenue number and they said, the average agency makes 2.5 times revenue. That's what I expect to make for my agency. And that's what I've been expecting to get for my agency for many years. They went to a broker. They listed their financials. One of my clients wanted to buy that agency, and we had to be the unfortunate people to tell them that their financials were wrong. You can't put premium as your revenue, and that cost of goods, it's actually the difference between those is the number that you actually keep. And in his mind, it was far less than what he always thought he was going to get for his agency, which is a pretty heartbreaking thing. So just make sure your financials are accurately reflecting what you think it should, and your growth rate is an accurate depiction of your overall performance. One of the most common reasons that your growth rate would be off is using, contingency income or total revenue, like we just demonstrated, or you're growing by acquisition and you add the new books in that skews the number and actually shows some pretty big spikes. That's still growth, don't get me wrong, but it's definitely not your organic growth rate when you do that calculation that way. Hopefully that gives you something to think about. But the better you understand your numbers, the better you set expectations for where you are and how your performance is, and the better you'll be when you're trying to transition internally to someone inside your agency or sell externally. Knowing these numbers inside and out really puts you in the driver's seat and creates confidence that a potential buyer understands what they're getting. So hopefully that gives you something to think about. Here are some average growth rates that are happening over the last 2 years. Obviously, we're in a hard market, so these numbers are actually skewed a bit by rate increases. It's really difficult to isolate rate, but these are broken by 500K in revenue all the way to 3 million. And then I also provided what best practices growth rates are, showing you what the bottom quartile, median, and top quartile, or top 25% of agencies' performance are for agencies that we see, over the last 18 months. Okay, so retention rate calculation. One of the most valuable parts of an independent insurance agency is your retention. It's why private equity is super interested in our industry. It's why they've come here and multiples have continued to increase. That predictability of that retained income is something that is incredibly valuable, but it's also a number that many agencies don't have a really good handle on what their retention rate is from a revenue perspective, policy perspective, and a premium perspective. And the reason why it's so difficult to get to accurate retention rate calculations are two reasons. Number one, process. So inside an agency, if you don't have consistent processes across your agency to catch, downloaded policies that are download as new, which means new to the carrier, and you don't catch that and label it as a rewrite, it will actually skew your new business and also skew your lost business, and your retention rate will not be accurate. So that's number one. Number two, our systems aren't designed to do this for you. So you have to put a process in place and you have to do this calculation on your own. So that's what skews the revenue retention and the premium retention, that new to the carrier download not being caught and being consistent across the agency. The policy count also has some challenges, because if you move an account from a policy that's a package to multiple policies when it's written by a different carrier, it also skews this number. So a consistent and accurate way of calculating that inside your agency management system is required, again, by your overall policies and procedures, in order to make sure that you can get an accurate count there as well. It's a challenge, but many agencies do put their processes in place to know their retention rate. If you're relying on carrier reports in order to report this, which many agencies that we value, that's all we have to go on, you really lose that movement between carriers. And over the last 2 or 3 years, that's been significant. And it really underestimates the overall retention rate inside an agency. Because this is so valuable, putting this process in place is one of the things I would highly recommend someone be very, very vigilant in, and watch it to see, are you commiserate with what the industry averages are for your retention rate from revenue and by policy and premium? And knowing both numbers is incredibly important, because right now, as we are in the hard market and potentially coming out of it over the next several months, our revenue numbers are over 100%, which makes it seem like we're doing really, really well. But your policy retention could actually be declining, and it's masking that there's a challenge that we need to pay attention to. So really getting this calculation tight inside your agency from a policy and from a revenue standpoint is incredibly important. So we talked about your organic growth rate as a metric that you should pay attention to. Your retention and your new business is something that you should pay attention to and make sure that they're very accurate. New business, not just premium new business, but revenue new business. And the only way to get to your new business on a revenue basis is to reconcile your commissions. If you're not reconciling commissions, you're going to have a hard time tying your new business to the amount of revenue you have every single month and be able to compare it year over year. So that's another area that is incredibly important, that you make sure that you're reconciling your commissions and tying it to revenue that is collected every single month. That is also a really big challenge for many agencies because your agency management system doesn't require you to do that. It doesn't require you to report revenue. So when we want to get financial statements and a book of business that tie together when we go to do evaluation, many times we get a book of business that's only in premium. We get financial statements that's revenue, and those two numbers are vastly different, even if we use an average commission rate to apply to their premium dollars. So reconciling your revenue and updating your agency management system with that number, it can put you again in the driver's seat and make sure that your reports are tying out and your numbers are solid when you want to go buy another agency, when you want to sell your agency, when you want to do anything, get a loan, etc. So the third metric that I think everybody should know is your EBITDA, which is your operating profit of your agency. It is the number that gets multiplied times the multiples we all want to talk about in order to get to the value of an agency. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So this is a guide of how to calculate EBITDA. It's a resource that we have. You can download the formula. You can download all of these things, but I'm going to show you on the P&L exactly where you find the numbers to add and subtract, like we're talking about. Unfortunately, this number does not jump off your P&L for you. It is a calculation that you have to do. So you start with your net profit or net expense, which is at the bottom of your P&L, which takes all your revenue less all your expenses to get to your net profit or net expense. Hopefully it's a net profit. And then you add back any non-cash or non-recurring items. So you would add back your interest if you have a loan, taxes that you paid to the IRS or to the state based on the profitability of your agency. You would add back any depreciation expense that's non-cash. It's based on an asset you bought a long time ago that you're putting that expense over time based on the IRS guidelines. You would also add back any amortization expense for a book that you bought or goodwill that, again, you're spreading over time based on the IRS guidelines. It's non-cash expense, non-operating expense. Then you would subtract any one-time income, like a PPP loan several years ago. You would take that out because it's skewing your number. Or potentially you might have sold an asset like a car, or you might have some income that only happens this year. Your carrier might have had an extra bonus that they gave you this year. You would take that out because it's not going to recur. You would also add back any one-time expenses that maybe you did this year, but you're not going to do every year. Something like rebranding the agency, or buying computers for everyone, or a one-time training that you did for everybody inside the agency, or maybe a trip that you decided to do this year for your 100th anniversary, but you're not going to do any other time. So one-time expenses that are significant, you add that back. And then you would adjust the overall owner compensation to be commensurate with what the IRS would require. Owner compensation can be very widely different from agency to agency. So putting an accurate and appropriate amount for an owner based on the size of your agency is important to have apples to apples. And then if you have any discretionary expenses, you might run certain expenses through your agency as a tax strategy to minimize your taxes, but they really aren't expenses related to running the agency, adding those back so you can get a true profitability of the agency is how you calculate your EBITDA. The way we do it is we put your agency into the categories that we described, into those P&L categories. We compare you to the benchmarks. We ask you for any one-time expenses or discretionary expenses that you could identify. We then see your variances to the benchmarks and ask questions. For instance, an agency might have an occupancy expense that's 3 times the benchmark. We're going to call and say, Does the owner own the building? And is this a way that you're compensating yourself? And we would adjust that expense to what a true occupancy expense would be in your area for that size building, etc. That's just one example. So we would use those benchmarks as a guide to ask questions to try and identify any discretionary expenses that are inside the agency. So this is the full P&L for the agency example that I'm giving you. And again, we would start with that pre-tax profit right here. We would then add back any of the expenses that come in this admin expense. So we would add back your amortization of intangibles, interest expense, depreciation expense. In this case, the agency has officer life expense. Again, this is not related to the operation of the agency. It's related to putting a perpetuation plan in place for this agency. So that's an expense that would be added back, because if we sold the agency, we would not continue that expense for the agency. And then we would right size the owner compensation to what the IRS requires us to have an owner make for this size of an agency. It's typically right around 6.5%. You can see in this case, the owner's compensation is at 5.3%. So just as a rule of thumb, it's somewhere around there. Depending on the size of the agency, that percentage changes, but I'm just giving you an idea of what it is. We would look for any discretionary expenses that hit these categories or one-time expenses that are in these categories in order to right size and get to a reasonable operating profit. So here, that's the areas that you would look at in order to calculate your EBITDA. Hopefully that's helpful. And any of those one-time income expenses we would also capture there. I didn't highlight that area, but that the one-time income is less common than the one-time expenses, obviously. Okay, so benchmarks for profit and EBITDA. These are also just to give you some benchmarks. So you're aware, overall for our agency, we get agencies that operate somewhere around a 17% profitability on a regular basis. That's what they come to us as. But many agencies can be corrected or adjusted to a 25 to 30% profitability. Awesome. Okay. What are some common actions that agencies will do once they're able to understand their financials in a much stronger way? Number one, they'll compare to those benchmarks and maybe ask themselves, am I getting the return on my investment in each of these categories? Very common to do with your technology investments, your marketing investments, etc. They might question, am I staffed appropriately given the investments that I'm making elsewhere? They might eliminate some unnecessary expenses. Once you categorize and really add up all those discretionary expenses, you might determine that you can reallocate your expenses pretty significantly if you'd like to, in order to invest in another way of growth or potentially in staffing for some of those things. You might find some opportunity for hiring, opportunity for maybe having some resources to put towards acquisitions or other investments inside the agency. But those are some common outcomes of looking at your financials in a different way, utilizing the benchmarks, understanding how they work together, and thinking about them a little differently. Okay, so just to give you an idea of what when we do some of these things for our fractional CFO clients, we definitely look at their overall commission and fee income as a percentage overall, what their growth rate is just of their commission and fee income, compare it to their overall budget as well as their performance prior year. We then look at their total revenue overall, which would include their contingency and other income. Again, that's a comparison of where you are as an agency, what we budgeted for your agency, and how you performed prior year in order to give you just an idea of how you're doing overall. We also look at your revenue retention, your new business revenue, and your revenue per employee. I put the example here just to remember to tell people, if you don't reconcile your revenue, you might not know your new business revenue, making it very difficult to know your retention and new business revenue metrics. This agency, that is their situation, something that we're working on in order to get to that reconciliation so they know exactly what their new business revenue is every single month. We also put one of the metrics that we look at is their revenue per employee. This number can vary widely based on the decisions that an agency is making, whether or not they utilize VAs, whether they utilize outsourcing, whether they have utilized service centers, etc. So taking it with a grain of salt, what the industry average is, what their makeup is, and what they could expect. So if you're an agency that has a ton of technology, you should, all other things being equal, assume that your revenue per employee should be higher than other agencies that are not tech forward. If you're an agency that utilizes a ton of virtual assistants, you might actually have a lower number because you've got more employees, total headcount of employees than another agency would, but your profitability should be off the charts because the cost of your total payroll would be less than an agency that has all W-2, all licensed people doing that work. So you have to take some of these metrics with a grain of salt and know the story behind the numbers, but getting to the metrics is part of the process in order to get there. So this is a tool that we provide to a lot of our clients. If you've never had a budget before, we provide a budget template for you to utilize and really think about what are your overall goals for the 12 months. How do you allocate your expenses into these categories and really help you forecast some clear assumptions about where you are overall. I think every agency should have a budget. It's really, again, you can't do these things and compare to where you think you should be. So you might be going through the year and think I'm doing well, but I'm only comparing to where I am last year, not where I want to go in the future. So having that budget allows you to have the metrics so you can do those comparisons and really think about your performance. Okay, so your compensation structure, since your people are your biggest asset and your biggest resource, having a compensation structure that makes a ton of sense puts you in the driver's seat, right? And this is one of the most common areas that someone might be off in their overall allocation of resources. For instance, you might be, I've seen several agencies where 70% of their revenue is going towards their people, making it very difficult to get to a 25% profitability and have any money left over to invest in their location, their technology, etc. So getting your compensation structure right is incredibly important. So number one, figuring out the number of people that you have and how does that compare to other agencies your size from a capacity standpoint. Are you overstaffed, and is it intentional because you're in high growth mode? That could be one of the reasons that your compensation overall in the agency is different and not aligning with the industry benchmark. If you actually have the same number of people or less people than other agencies, it could mean that your commission structure is off. You're paying too much in new and renewal. You might not actually be creating or implementing the thresholds for your producer compensation, where you end up with producers that get large books of business that are being paid new and renewal, in addition to the service people who are maintaining some of their accounts. Therefore, the agency is paying both a service person and their producers for books of business that are only being maintained by service people. So not creating those house accounts and creating those minimum thresholds for large books of business could also be an area that your compensation could be out of whack. Other common things, you could be not doing commission at all and paying base pay, and you have producers that are not validated. They're not covering the cost of what their overall cost is. Their book size is not covering their cost. You could have inflated costs because you've got combined roles and your service people are being paid far more than the average agency is. So there's lots of different reasons why comp structures can be out of whack. But getting this right typically accounts for 50% of your total resources. So making sure that you are in the normal range for some of your compensation could be a make a huge impact on your agency. Oftentimes we will work with agencies that have realized that they have adopted comp structures that are not commensurate with the industry. And oftentimes we build a plan to get from where they are to where they need to be, which is, something that's implemented over time and would include offering incentive comp plans or incentive compensation to bridge that gap for their clients or for their staff. So the only thing I would recommend here is if you are in this boat and your comp structure is not commensurate with what the industry averages are, and you are approaching potentially selling your agency sometime in the near future, don't wait for the buyer to correct your compensation, because the buyer will view that as a risk factor inside your agency. And if they have to change the comp structures of your people in that sale process, they will also assume that the retention of your book could decline if they lose key employees and customers follow them. So it actually could be very detrimental to you not to deal with your comp challenges and allow someone else to do that. That is not a good strategy at all. Okay, common ways to create capacity inside an agency. Number one, know the benchmarks of what you should expect your people to be doing, especially compared to what technology and automation, et cetera, that you have implemented inside your agency. I would also challenge you to think about documenting your processes and looks for ways to streamline and eliminate some work that maybe you don't need to do. Make sure everybody's following the same process, and look for inconsistencies in your team that might create some capacities as well. You might be able to eliminate, reassign, or automate some of the parts of roles, especially in service, to virtual assistants, or you might be able to reassign some of it to automation or technology or AI. But first and foremost, you got to get the process clean. You got to get the volume of work identified in that process in order to identify those areas that you might be able to use these other resources that exist in the industry. One of the biggest things that I see is, you go to a conference, you talk to another agency owner, they say, we're using technology, and you say, that sounds amazing. You bring it into your agency, it's never utilized, or it doesn't get rolled out appropriately, and it ends up becoming an expense on your P&L. It doesn't create the capacity, and therefore it actually hurts you on both sides. Your team is mired because they have to try these new things that don't actually land appropriately, and it's an expense that you're not getting the return on. So I would say start with creating the process, creating the opportunity, and moving that work based on your experience, your makeup, not necessarily what other agents have working in their agency. They might have a completely different structure than yours. We compiled a list of the common things that agencies are using virtual assistants as, or virtual assistants inside their agency as a resource. By no means, we are not a VA company. I'm just telling you that these are some common things that agents tell us that they're utilizing VAs for, just to get your brain working and maybe help you rethink. Maybe there's expanded ways you can use this resource. Many agencies are under 1.25 million in revenue. About 83% of the industry is under 1.25 million in revenue, and half of that is actually under 500,000 in revenue. So they may not have the volume of work in order to command the RPA technology or some of these technologies, but stratifying the work and utilizing VAs have been incredibly impactful inside their agencies. So I want to just, provide a resource that might help you think about creating capacity inside your agency. Some of the other areas that by looking at your financials differently, you might think about, okay, from an efficiency standpoint, what are some things that I can do? I'm not as efficient as other agencies, therefore I'm not commanding the same profitability. What are things that I could do? So number one, think about the roles that your people are and maybe doing that work differently. Number two, let's increase the focus inside the agency and potentially tier your customers, not treat everybody exactly the same in order to create some capacity for your team. So lots of different ways to tier your customers. Maybe we'll do a whole segment on that topic in general, but that is a very common thing, especially in this hard market that many agencies have resorted to because it's just impossible to get to all of the volume of work and treating everybody exactly the same. Definitely calculate your profitability by line of business and think about it. Maybe there are monoline accounts or really, really tough accounts that are spending a lot of time and energy on that aren't as profitable as other areas, where you can start to really think about where are my growth strategies? What do I want to market to? And make sure that you're focusing on those areas that are most profitable and streamlined for your agency, not necessarily doing everything across the board. So if you find we're really, really good in these couple of niches, or we're really, really good, that's what you should market to, because those are the things that are going to drive profitability and efficiency inside your agency. So these are some common strategies that agencies are using in order to drive efficiency inside their agency. Last but not least, know the risk factors inside your agency. This is an incredibly valuable asset. Knowing your numbers and knowing how they all work together is fantastic, but also knowing what your risk factors are and thinking about those and not letting those get away from you. So, what is your staff demographics? Do you have some risk in the aging of your staff or the gaps in your staff? What is your producer concentration? Who's driving the new business inside your agency? And is it really concentrated with one person that might be getting ready to retire? Like, where is all of that happening and how can you mitigate that risk? Do you have an account manager that is a workhorse and maybe could train other people in order to really work in a very efficient way? Or do they have a body of knowledge that won't be transferable when they leave inside an agency? Look for those linchpins inside your agency and make sure that you can mitigate that risk as much as possible. Have employee contracts for non-piracy, non-solicit. If you have producer-owned books, make sure you've got contracts that are clear and that there's a tag along with those producer-owned books so you can simplify that process if you ever want to sell your agency. It's the number one way to slow down a deal when there's multiple producer-owned books with unclear agreements. What is your client concentration and who is included and in those accounts with you? And is there a way to introduce your whole agency or multiple people inside your agency and those clients in order to broaden the exposure and increase the likelihood that those clients will stay with you if one person is no longer part of the agency or retires, etc. Look at that expertise and talent assessment across the board and make sure that you have the ability to cross-train or outsource key areas that might be a risk. Accounting might be one of the most risky things. If we have one person doing the accounting or it's just the owner, it's very expensive to have the owner do that work. If it's one person that's at retirement age, it's really difficult because it's usually the area that you don't have duplication. So think about outsourcing parts of that to mitigate the risk inside the agency. Have a written, documented perpetuation plan if something happens to the owner. This is the fastest way an agency sells at a discount, is having no documented plan with one single owner past the age of retirement. Even an owner that isn't past the age of retirement with no written plan, there's this major delay to figure out what to do. And that delay creates uncertainty. It typically creates some loss of staff. That would lead to loss of clients. Your carriers get nervous. It's just a way to strengthen your agency by having a written plan. create an incentive compensation pathway to ownership for the key people inside your agency. So they want to stay with you and they don't want to go do this on their own. If they're valuable, give them a reason to stay with you. I would love for you to read a case study on an agency that got a valuation and then 3 or 4 years later got a second valuation and doubled the value of her agency. It is an inspiring story. We publish a whole bunch of case studies like this. This happens to be one of my favorites. So knowing your number, knowing the risk inside your agency does put you in the driver's seat well before you want to sell your agency or transition to internally to someone. I'd love for you to read that and maybe get inspired about something you should do inside your agency. If you want to talk to anybody on our team, this is how you get a hold of us. You can schedule a call with us and we're happy to talk about your agency specifically. We have a couple minutes. If someone has questions about what was presented here, I'm happy to answer those for you. But thank you for coming and spending time with us for sure. And Christy, thanks for having your camera on. It's always nice to see a face, so I appreciate that. All right. RPA technology is repetitive process automation. So it's taking something that someone could do individually, or you could have a VA doing, but a bot ends up doing it. A programmed bot does that. Yep. Oh, you guys are welcome. Thank you so much for coming. I appreciate it. Beth, it was so good to see your name. I don't know if you're still here, but thanks for joining us. And your face. Yeah, love it.
I'm still here. Just,
Yeah,
I'm in a hoodie
congrats
because it's
on,
rainy and cold. So
I love it. Congrats on your Boston run. That's pretty exciting to see.
thank you. Yeah, it was fun.
You're welcome.
Yeah.
Anybody have other questions? I don't think so, but thank you so much for spending your afternoon with me. I love doing these. If you have thoughts or things you want to learn about and you want to share it with us, please, please, please don't hesitate. Lindsay at AgencyFocus.com will take all of your suggestions. How about that? You like how I did that, Lindsay?
That is very good.
Yeah. Awesome. Do you want to put that in the notes, Linz? Your email?
Sure.
Cool.
There you go, guys.
Perfect. I love it. All right. Well, if there's no questions, I'll probably jump off and we'll see you next month. How about that?
Sounds
Thanks,
good.
everybody.
Thank you.
Bye-bye.